Well, good morning. My name is Greg Sizemore, and on behalf of the Construction Users Roundtable, we welcome you to this very special event with one of our country's leading economists when it comes to real estate and all things construction, Mr. Anirban Basu. We'll tell you about him in just a moment. Before we get started, however, we would ask that you mute your line. I think we've got everybody muted. If there are questions along the way, please put them in the chat box and we will get to them as expeditiously as we can. Folks in the other room, let's mute our microphones, folks. Thank you very much. Folks in the other room, we're going to kind of compile the questions, those that are similar, and then they're going to shoot them off to me and I'll repeat them to Anirban here in just a moment. I would like to remind you of some upcoming CURT events. We've got a virtual summit, a webinar, if you will, that's going to be held on April the 13th, and then a CURT Connect on lean project delivery that's going to be held on April the 13th. Then we have our upcoming May meeting here in Cincinnati, a wonderful 3-day event. All of these events can be found at curtevents.com. That's the website, curtevents.com. And so we encourage you to check out the things that are coming up and encourage you folks to participate. Also, this event is being recorded, and the reason it's being recorded is so that we can edit it and get it out to you next week, and you're free to share it internally as you wish to your colleagues. So be reminded of that. Again, if you're just joining us, the questions are to be put in the chat box, and we're going to give the microphone over here to Anirban just as soon as I introduce him to you. I think he needs no introduction to the vast majority of the folks on this call, but I will tell you that Anirban Basu is chairman and CEO of Sage Policy Group. It's an economic and policy consulting firm headquartered in Greater DC, Baltimore, Maryland, actually, and it provides strategic and analytical services, economic data, if you will, to energy suppliers, law firms, government agencies, contractors, both union contractors and open contractors, and to owners. We have engaged Anirban on a number of projects over the years. He's always fun to listen to, very informative, and we're excited to have him with us. The topic du jour, as you folks know, is the Ukraine-Russian conflict and its impact on the construction industry, what it means for the U.S. Construction Committee. So again, without further ado, we're 4 minutes into our time, and we want to quickly turn our time to Mr. Anirban Basu. Anirban, it's all yours.
Righto, thank you very much for that very kind introduction. And it's great to be with CURT folks today. I am sharing my screen. Hopefully you can see this. I've developed a presentation just for this event, just for this Friday morning. Blue, yellow, and red, of course, 3 prominent colors involved here. What Ukraine-Russia means for the U.S. construction industry. Generally speaking, I talk about the economy, but had the good fortune of studying international relations at Georgetown University. And then,
Anirban, we've got you muted, my friend.
Yeah, somebody muted me.
There you go.
But so anyway, I had the opportunity to study international relations at Georgetown International Development at Harvard, and then I've had the opportunity to speak in various parts of the world, over the course of a 30-year career. So in any case, I hope you enjoyed this. This is about what Ukraine and Russia means for the U.S. construction industry, and of course, this is all taking place in the context of broader economic trends and patterns, which we'll also talk about. Please do use that chat box to ask your questions, because actually we've developed this or organized this such that the majority of the time is Q&A here, as it turns out. Let me give you a bit of a brief timeline here. And this is important. Why? Not just because it's interesting history, but because it may give us some insight into how this conflict will proceed and how it might end. So just 2 slides on the timeline. Russian President Vladimir Putin demands security guarantees early in 2021. Ukrainian President Zelensky cracks down on pro-Russian Ukrainian oligarchs, including a close friend of Putin. So that's important to note, that Putin actually, believe it or not, feels aggrieved. He feels victimized. Putin begins deploying increasing numbers of troops near the Ukrainian border in March and April of last year, about a year ago. Putin publishes an article claiming that Russians and Ukrainians are one people. And that's another thing about this. Putin does not recognize, as you've probably heard a million times, Ukraine as a separate nation. This is probably also true for nations like Moldova and other small former Soviet republics. By December of 2021, tens of thousands of Russian troops are massed along the Ukrainian border. Remember, at this point, as this is happening, many people are skeptical that there's going to be an invasion. It would be sheer madness. But to understand this, one has to put themselves, I suppose, in the shoes of Vladimir Putin. Putin issues demands to NATO and the US. Among them is that Ukraine never be admitted to NATO. That happens on December 17th of 2021. So he's amassing these troops and saying, look, I'm serious about this. Ukraine can never be admitted to NATO. I need that to happen. It doesn't happen. Putin's demands are rejected on January 7th of 2022. So again, Putin feels aggrieved. He does not feel that Ukraine is a sovereign nation. Some of his friends were cracked down upon by President Vladimir Zelensky. And so in some sense, he feels victimized by this. And that's why, again, I'm not saying that his perspective is a reasonable one, but we care about how this conflict ends. And if in fact Putin feels aggrieved, then of course he's likely to persist for a lengthier period. Just more about the timeline. February 21st of 2022, Russia recognizes breakaway Ukrainian regions as sovereign. Following the breakdown of relations with NATO in the West, Putin recognizes the Ukrainian regions of Donetsk and Luhansk as independent states and sends in troops to, quote, keep the peace. Donetsk and Luhansk broke away from Ukraine back in 2014. The move was led by what the Ukrainian government considered to be Russian-backed terrorists. So the Ukrainian government looks at this and says, well, this is terrorism. We're a sovereign nation. These are terrorists operating within our territory, supported by the Russians. We're just simply, this is the makings of war. Two completely different perspectives. You're not a nation. We are a nation. We're a sovereign nation. And you are impacting our domestic affairs. Buzz off. February 24th, 2022, Russia launches a full-scale invasion of Ukraine. Putin announces the launch of a special military operation and begins a full-scale invasion of Ukraine. President Zelensky declares martial law in Ukraine and officially breaks diplomatic ties with Russia. And here's a key piece, this next bullet. Later that day, Zelensky orders a general mobilization of Ukrainian males 18 to 60 years old. And I think much to the chagrin and surprise of Vladimir Putin, as Zelensky is calling on Ukrainians who are ready to defend their country to come forward, and they do. And they have defended their country nobly, bravely, and as you would expect from a sovereign nation, proud of their heritage, proud of their culture, so on and so forth. So that's where we, that's how we got to this period. Now, what of course also matters is how the war has progressed. This map is current through yesterday, March 31st of 2022. Of course, today is April Fool's Day. I hope I'm not making a fool of myself, but you can see the red areas controlled here by the Russians. But you notice also, you see some blue areas around Kyiv and Kharkiv and Kherson. See that? Why is that? Why is that important? It's important because it shows again that the Ukrainians are capable of pushing back the Russians, that it's actually happening. And it also probably changes ultimately the Russian stance on how this war is going to end. And so the notion has been that that all of a sudden Putin, and again, one of the things that's happened in recent days is that Western intelligence services, particularly the U.S. intelligence service, which by the way has been right on point during this period, right, predicting, unlike the French security services, predicting that Vladimir Putin would in fact invade Ukraine, and also now suggesting that Vladimir Putin is not aware of how badly the war is progressing. But there seems to be some evidence that there is a shift in strategy here, that instead of trying to invade all of Ukraine, that there's now focus on that eastern territory, that so-called Donbass region. And so anyway, the war is ongoing, and of course we care about the economic effects, but I just want to give you some sense of what's going on. You can see Mariupol here, that devastated city toward the southeast of the slide. Lots of fighting to try to get control of Odessa, another major port city. In fact, I believe Ukraine's largest port city. So in any case, war rages on. And here's another thing. Ukraine, often we focus on the Russian economy, and we're going to focus a lot on the Russian economy and what it produces for the world. But the Ukrainian economy is not an insignificant one. 44 million people is not an insignificant tally, but 4 million of those folks have left the country, the majority of them for Poland. You can see about 2.4 million. And the Ukrainians are, for instance, major producers of wheat, but some other items as well. And so it's going to take a long time, of course, to put the Ukrainian economy back together. And so that's just another supply chain issue facing the world. Now, let's talk about the Russian footprint. So on the left-hand side of the slide, you see Russia's top 5 exports. They are crude petroleum, refined petroleum, coal, natural gas, and wheat. And you can see I've put in the amount of Russian exports in billions of dollars, and I've also put the percentage of global exports that Russia is responsible for. And in the area of crude petroleum, it's responsible for 19% of exports, not 19% of production. No. So we Americans, for instance, we produce a lot of oil for ourselves. So, there is domestic production, of course, and, within countries. This is exports, and the Russians are major exporters of crude petroleum. Now, you might say, well, Anirban, if that's the case, then why are oil prices even higher? In fact, they this morning fell below $100 a barrel. Well, at the same time that this is happening, Omicron is spreading through Asia and parts of Europe. And so the Chinese, a couple of weeks ago, shut down Shenzhen. Oil prices fell in the range of $17 a barrel almost immediately. And then more recently, they've shut down parts of Shanghai, and oil prices have come back down again. Oil is trading right now in North America at $90.84. And so while the effect of the war between Russia and Ukraine has driven oil prices higher, we also have some other global events here that are significant in terms of moving oil prices. You can also see the Russians are major producers of coal, natural gas, of course. We'll talk more about natural gas in an American context in a moment. And then, as I say, wheat. If you look toward the right-hand panel here, Russia is also among the top exporters of certain metals. Well, this is, of course, very important for construction. They are significant producers of iron and steel, significant producers of aluminum, nearly 11% of the world's supply. Now, palladium is, I don't think, so much used in construction, but it is used in catalytic converters. But copper, 8.2%, is used in construction, of course, for instance, wiring. Nickel is used for metal plating, for instance. And so, again, that can enter construction as well. So, look, we know that construction materials prices have been rising. According to the most recent data through February, they're up 24.4%. Much of that data captures pre-Russian invasion of Ukraine, though it is true that coming into the crisis, you'll remember that prices were edging higher for materials and other aspects of the economy. And so this does not help. If you're a construction user, you're saying, boy, when can I put this project out to bid and try to get lower bids? Well, on the one hand, you're getting still wage pressures, and we saw construction added an abundance of jobs, at least non-residential construction added an abundance of jobs in March, according to the most recent data, the data released today at 8:30 a.m. Eastern Standard Time. The construction unemployment rate continues to be reasonably low, and the industry is struggling with finding enough skilled workers. If you look at the composition of the construction workforce, one of the leading growth occupations is unskilled laborer. So while the industry is losing often to retirement very skilled workers, skilled craftspeople, it's a hiring often unskilled workers, and many contractors are hoping that they'll stick around for 3 months or 6 months, demonstrate that they're reliable, and then can ultimately be trained up to be more productive. So when you factor in labor cost increases and commodity price or materials price increases, that's a lot of inflation. So if you've been a construction user and you've postponed projects, project start dates because you're waiting for more favorable bids, we're not to that point yet, clearly.
Yeah.
So now, here's the other thing. Let's say the war ended today, but the sanctions won't end today. And the sanctions are going to continue perhaps for years. Russia is now the world's most sanctioned country. So let's provide some data on sanctions, shall we? So you can see, if you look at the red colored bars here, how many sanctions. The darker, let's call it the burgundy, were sanctions before February of 22nd. Russia was not a beloved nation in much of the world before, as it turns out, the war, but much less so during this war. And you can see how many sanctions have been added to the Russians, so that prior to the Russian assault on Ukrainian democracy, Iran was the most sanctioned country in the world. In fact, right now, you can see that some of those sanctions may be ready to be unwound as the world, or some parts of the world, try to pursue a nuclear deal with the Iranians, a renewal of that 2015 deal. Since February 22nd, more than 5,000 sanctions have been placed on Russian oligarchs, companies, banks, and other entities in a range of areas, including trade, travel, and financial activity. So this is the seizure of yachts, This is Roman Abramovich having to sell the Chelsea football team. I still don't think he's done that, but he's trying. Some of the most notable actions include freezing Russian central bank assets, cutting off Russian banks from the SWIFT payments system, Germany's suspension of the approval of the Nord Stream 2 gas pipeline, U.S. ban on Russian oil and gas import. So even if the war were to end today, a lot of that Russian commodity, whether oil, natural gas, will be locked in Russia. Now, remains to be seen how the Chinese or the Indians, also the Indians depend heavily upon the Russians for energy and also weaponry. We'll see how those countries respond. And so those would potentially be outlets for these Russian exports. But nonetheless, from the perspective of the West, a lot of this Russian supply will be cut off for perhaps many, many years to come. This gives you some sense of the daily number of restrictive measures imposed on Russia from February 22nd to March 24th. Now, again, the invasion began on February 24th, and you can see immediately the Swiss come out with a bunch of restrictive measures. Now, remember, the Swiss are neutral, but even the Swiss are enough to be non-neutral, upset enough to be non-neutral in this context. You can see Australia responding, and then later in March, you can see the English and the United States, sort of stepping up more and more sanctions, so on and so forth. And so, this is a real change in the way we see the world, isn't it? Because the notion was that after World War II would turn swords into plowshares, that we would create the General Agreement on Tariffs and Trade, ultimately, which would become the World Trade Organization, that we would engage countries around the world in trade and mutually beneficial economic engagement, and that would keep the world at peace and prevent a World War III. And to date, that's worked. But of course, this engagement with the Russians. So one of the reasons the Germans were buying natural gas from the Russians was to keep the Russians peaceful as a society. So, beneficial trade. But for Vladimir Putin, even that was not enough. And so here we are. Sanctions on Russia since February 22nd of 2022. And this, by the way, this is where a lot of the economic impact is from. It's that it's not that the Russians can't produce oil and natural gas. It's just that we're not willing to buy it, even if they do produce it. So a lot of these sanctions, by the way, are on individuals, on these oligarchs, right? Taking their yachts and maybe their football teams or whatever else they're going to take, maybe homes and so on and so forth. So it's, in absolute numbers, a lot of this is on individuals. And those individuals often are close to Vladimir Putin and saying to Vladimir Putin, what are you doing? And they might be actually outlets for higher quality information to Vladimir Putin than his own generals are about what the world, what's going on with the war, how the world is responding to this, the fact that the Ukrainians, in fact, are a sovereign nation and are defending with their life their liberty. So this is a map of countries arming Ukraine and/or sanctioning Russia. You can see many of the countries that are arming Ukraine are also the ones that are sanctioning Russia. Now, the Japanese and the South Koreans have not sent arms to Ukraine. That's basically the difference between these two maps. They're sanctioning Russia, but they're not sending arms. But otherwise, you can see the West, the Western world, plus Australia, very much behind Ukraine. And notice something: the Finnish, for instance, Finland borders Russia. Even they're arming Ukraine. And so that's an expression that maybe they're not so scared of the Russian military anymore. I don't know, but the Russian military certainly is being embarrassed out there by these Ukrainians. And obviously I view that as a very positive thing. Okay, let's get to the economic situation. So here's some futures prices for select commodities, many of which pertain to construction, some which do not. But, if you look at the January average price versus the price as of March 30th, 2 days ago, crude oil prices up 22%. And remember that even before Vladimir Putin, again, invades Ukraine, there was some upward movement in oil prices and some other commodity prices because of the risk of an invasion. Coal up 62%, wheat up 35%, natural gas up 15%. Well, these are significant inputs into construction, crude oil and natural gas, for no other reason than construction materials have to be transported to job sites. You can see copper up 10%. Well, that's a significant input. Aluminum up 15%. Nickel, which again is used in steel production, up 46%. And you can see North American steel up about 60%. North European steel up about 60%. We haven't seen much change in Midwestern domestic steel prices just yet. And again, one of the factors that's countervailing some of the impact of the Russian invasion is the issues in China. And by the way, the Chinese were not looking at a good 2022, even before the spread of Omicron there. The Chinese government has set a target of 5.5% growth in China for 2022. That's the lowest target set in 25 years of planning. And many economists agree that China will not reach 5.5% growth this year. So if the Chinese economy is not growing, all things being equal, that has downward pressure, meaningful downward pressure on commodity prices, as China is home to a quarter of global manufacturing. And so, we'll see where these prices go, obviously, but the effect of the war, if you ask me, Anibal, what's the effect on construction? It is negative. Because what it does is it exacerbates what had been a pre-existing issue for construction users and also suppliers, which was elevated bids, elevated delivery costs of construction services. And this does not help. By the way, natural gas is up half a percentage point today to $5.67 per million BTU. So conclusion, conflict has predictably produced significant commodity price inflation, which will back up into materials prices, already has begun to do that. Even were the conflict to end today, sanctions could be in place for years, limiting long-term Russian supply of key materials. Hey, here's a positive. Massive opportunities opened up for U.S. energy producers. The dream is real. America positioned to displace Russia as a supplier of natural gas to Europe, and of course, also to come to represent more oil exports around the world. Now, one of the things I've been frustrated by, and by the way, I hope that eventually we're weeded off fossil fuels. I like the notion of solar and wind and so on and so forth, and kids running through green grass and so on and so forth, and drinking clean water, all of that. I mean, but we're going to use a certain amount of oil in this country this year. We are. I drive a Ford Mustang, and she needs 93 octane, and she's going to get it. I have nothing against Qataris and so on and so forth, and if they produce more oil for us, I'd rather buy it from us. And I've been disappointed to see the American oil producers have not really significantly increased their rig count, even though oil prices, are much higher than they were, pre-pandemic, and they can make more money. But my very strong sense is, at least until recently, many oil producers simply saying, look, we're producing a certain amount of oil, we're getting paid handsomely for it, we're generating enormous profits, we're not having to invest in a lot of new equipment, not having to pay for more permits and so on and so forth. I'm able to hand out enormous dividends to my shareholders. My board is happy. I'm the CEO. My board is happy. My compensation committee is happy. Therefore, I am happy. Why would I sort of massively increase oil production when that could come back to burn me by causing me to have to spend cash? And then what happens if oil prices fall at some point in the future? So, I've been frustrated to see that U.S. oil production is meaningfully below what it was pre-pandemic and not really taking off. Because as I say, we're going to use a certain amount of oil in this country this year, and I'd rather buy it from us. But in any case, the opportunity is very real here for us to export more energy to the rest of the world to displace the Russians. Bad news, headline inflation numbers will remain elevated, prompting the Federal Reserve to raise rates faster and higher. Can they engineer a soft landing? Let's talk about this, shall we? So, the headline numbers are really elevated. Everyone knows, inflation running at the consumer level at 7.9% over the past year for which we have data, again, according to the Consumer Price Index. The conventional wisdom is, as you know, the Federal Reserve already raised rates once by a quarter point, that at their next two meetings, they will raise rates by 50 basis points at each meeting. So interest rates are ramping up rapidly. And what they're trying to do, of course, is engineer a soft landing. So they're trying to slow the economy, wring inflation out of the economy, but not drive us into recession. There have been 8 Federal Reserve tightening cycles since the early 1980s. 6 of those 8 have ended in recession. 6 of those 8. Even the Orioles have a better record than that. And so can the Federal Reserve, the Orioles won a third of their games just about. So, so what that means is that can they engineer a soft landing? Most economists would agree. I certainly would agree with the notion that the Federal Reserve is behind the curve. They should have been raising rates sooner, earlier, trying to contend with rising inflation expectations at some point in 2021, as the economy was really starting to rebound and coming out of the pandemic, and the unemployment rate was falling back towards pre-pandemic lows. We got a report today from the Bureau of Labor Statistics indicating that the inflation rate down to 3.6%. Well, it was 3.5% before the pandemic. So the chances of recession are pretty high. So what does that mean? That means that yes, commodity prices are high now. Could they fall significantly later in the year? I think the answer is yes, they could. I think actually asset prices generally, stock market, for instance, there is some room to the downside there as well. So, I mean, you may disagree with that, and that's what Q&A is all about. Will contractors remain convinced that they can pass along cost increases to project owners? Just well, I'll skip it. There is, we do a survey at Associated Builders and Contractors, of which I'm the chief economist. And our contractors, and several hundred contractors answer that survey each and every month, are telling us that they expect over the next 6 months their sales to increase, their employment to increase, but they also expect their profit margins to increase. And that's the one that has shocked me, because what the contractors are saying is, we think we can pass along these cost increases to construction users, to the project owners. And I've been saying, I'm not so sure that that's true. And I conducted another presentation recently for another group, or actually a magazine, Construction Executive Magazine. And one of the poll questions I had up there was, do you expect your profit margins to rise over the next year? And there were a handsome share that said of construction firms expected their profit margins to rise over the next year, meaning that they expect to be able to pass along these cost increases. But I noticed that there was about a third of them that said, no, we think margins are going to fall. And that to try to induce project owners to move forward with some of these projects, we're going to have to chip away at our margin to induce them to move forward. So anyway, that tale is yet to be told, but that's my presentation. Let's, I think, Greg, the time has come for us to move to Q&A.
100%. Thank you, Anirban. And we're going to move swiftly into Q&A. I have questions coming in on text on my cell phone. We have some in the chat box as well. For those of you who just joined us, if you'd like to ask a question, put it in the chat box. We'll try to get to it as soon as possible. So here we go. You said the chances of recession are high. What are the other consequences of the recession on construction projects as you see the future today?
Right. And I want to be clear, I do not expect that, Greg, in the immediate near term. The economy has momentum. We added, according to today's data, 400,000 plus more jobs in the economy in March. The numbers from previous months, January and February, the employment estimates were revised upward. And it's important to note that not only are we adding jobs, but we're adding jobs at quite high wages. That unlike previous months, we saw a lot of job growth in segments that are not leisure and retail related. So some higher wage segments, and of course, people are getting chunky raises, and so that creates spending power. Granted, they're spending in an inflationary environment, but between consumer spending and business investment in equipment, because they're struggling to find workers, they're investing more in technology and equipment, and the state and local government outlays should be strong this year. And then, of course, with that infrastructure package, being unrolled, that was signed by President Joe Biden on November 15th of last year. So with all that, I don't think there's recession in the immediate near term, but 2023, in my mind, is a year that could be challenging. Remember, the Federal Reserve is trying to slow down the economy. They're going to promulgate chunky interest rate increases during the year ahead. And we've gotten this bump in economic activity as we've come out of the pandemic, and people have engaged in activities that they hadn't been engaging in, like taking vacations, so on and so on. At some point, the positive economic effect of that begins to subside and normalcy comes to the fore. And so what would it mean for construction? Well, look, construction tends to lag the performance of the overall economy by 12 to 18 months. And we've got, if you're in public construction, by the way, you're going to be busy for the foreseeable future. In much of the $1.2 trillion infrastructure package we spent over the next 5 years, not all of it, but much of it. So if you're in public construction, you're going to be very busy. But I am worried about private construction. And actually, in March, believe it or not, home builders, residential construction actually lost jobs. So there might be some indication that these rising interest rates are already starting to slow housing construction in America. And I would expect that to extend to private non-residential construction at some point in 2023, if not later this year. And so I have been surprised that the contractors have been so optimistic, particularly about profit margins. So hopefully that answers that question.
Thank you. Are the Section 232 tariffs the reason that the U.S. Midwest steel prices are remaining steady? And what long-term impact do you expect on the 232 tariffs?
Right. So these are the tariffs that were imposed by the Trump administration because of national security on steel and aluminum. And those are being rolled back. as it turns out. So what they're doing is, with the United Kingdom and some other countries, Japan, I believe, they have been engaging in what's called sort of these tariff quota agreements. So up to a certain point, the British or the Japanese can sell steel into the American marketplace. So the historic level of steel sales without those 25% tariffs. But then above that, if they move above that in terms of steel sales, then all of a sudden but that additional steel sale is subject to the 25% tariff. So in any case, yes, I think that the policy by the Biden administration to lift some of these tariffs, these trade restrictions, are helping to keep those prices stable. So if it weren't for that, you would have seen a meaningful increase in steel prices in the Midwest.
So here's another interesting question. Knowing what you know, if you were a construction owner contemplating a major project, how would you go about your decision making based on the fluctuation of the raw materials and the tariffs and all these things that you know about? What would be your decision making protocol for an owner if you sat on the owner's side of the fence?
Okay, so if I sat on the owner's side of the fence, and remember, I'm the chief economist for a number of organizations that are contractors, right?
Yeah.
So but let me just be honest. I'll be honest. I might be tempted to wait. I might be tempted to wait to bid out the project or engage in the project start. Now, again, there's some dynamics there. There's, you've got your permits, you're ready to go. If you've got your general contractor lined up and the general contractor has subcontractors lined up, it's not necessarily costless to simply say, you know what, we're just going to postpone it, right? So I understand that. But if you're sort of dealing with a tabula rasa, a clean sheet, in front of you and say, how should I time this? Will there be a point in the future when I will be able to benefit from less expensive delivery of construction services? Greg, I think the honest answer is yes. I think that there is such a moment. Now, again, that might not be true as much in public construction, right? Because public contractors are going to be busy for many, many years to come. I'm really speaking about private construction, as it turns out here. But we are seeing more people come back into the American workforce. Labor force participation rate ticked up to 62.4%. We saw some entry of workers back into the construction industry as well. One of the reasons for that, by the way, is inflation. So people are increasingly living from paycheck to paycheck once again. The stimulus packages are behind them, increasing the rearview mirror. They're struggling to pay basic bills, and so they come back into the workforce. That's actually good news from the perspective of the supply side of the economy. So I might, as I say, I might be tempted to wait, look for a period during which the construction delivery costs are not quite as high as they are right now. And I think at some point we will get that.
And at that some point, we know it's crystal ball, but what would be your anticipated runway on that? Are we talking 6 months, 12 months, et cetera?
Yeah, I think it's more like 12 months. Right? Because yeah, I think so, because right now contractors have lots of backlog, right? And so I do a survey for ABC, and the average contractor has a backlog of about 8 months. Well, it's going to take more than 6 months to work off that backlog, right? And of course, they're going to continue to bid on projects and and there's no indication the backlog is really declining. So contractors are busy right now. So there are probably some contractors out there who are saying, Basu, you're wrong. They shouldn't wait because we're going to be busy for quite some time. Yeah, you're going to be busy for quite some time. But if I'm right that the economy is much weaker in 2023, ultimately contractors become less busy, let's say later in 2023 or 2024, and that might be the point at which you will see more aggressive bidding, right? Contractors offering more favorable bids and also benefiting perhaps from lower construction materials costs at some point. Because I really think that some of these prices are just elevated by geopolitics, and once these geopolitics are behind us, we might see better supply chain outcomes, lower prices, and contractors would be happy delivering construction at lower prices, and of course, project owners are happy to receive those lower prices.
Great. Another question is: you often hear for the call of opening the Keystone Pipeline and opening some of the things that President Biden shut down on day one of his administration. Would that have an impact on the price at the pump? And the price of gas in general, fuel in general, if he did open the pipelines?
Yeah, if he allowed us to develop more pipeline, to develop more pipeline capacity, of course that would help, including in places like New England, for instance, where they pay outrageous sums for natural gas, often imported natural gas. So yeah, I mean, I think so. I mean, I understand the push to get away from fossil fuels. I get that. But it's a strange thing, don't you think, Greg? So on the one hand, you say we got to get away from fossil fuel use, right? And one of the ways to do that is to constrain pipeline capacity so people can't use as much oil and natural gas. And then we see these millions of barrels released from the Strategic Petroleum Reserve, which of course has the opposite effect. It causes gasoline prices to fall, and then of course we end up using more gasoline because prices are lower. So what is the goal here? What are we up to here? What I would say is this, Greg. We have an industry here, a very large fossil fuel industry here. We're the cleanest producers in the world. So if anyone should be producing a lot of oil and natural gas, it's us. We're the best technology, the best people, the smartest workers, all those kinds of things, the most responsible, transparent companies. And then privately owned, shareholder owned, have to report out every quarter to shareholders and other stakeholders, lots of transparency. So if we're going to use oil in this country, or if the world's going to use oil, I would rather see the Americans gain market share. And certainly for our own needs, I would rather see us gain market share and pipeline capacity support. The energy has to be able to move. Yeah. So I would say that some of this policymaking has to be rethunk, and that actually rather than releasing oil from the strategic petroleum or strategic oil reserve, which could be valuable to us at some point in the future, I'd rather say, look, let's cause prices come down in a different way. Let's add pipeline capacity and produce more and distribute more for ourselves.
Do you expect a 2 to 10 year Treasury rate inversion this year? And how reliable is that as an indicator for a recession?
It's already happened. The inversion has already happened. We are inverted right now. The 2 year is at 2.444%, and the 10 year is actually less than that. So we inverted yesterday, as it turns out. And I have viewed that as a fairly reliable indicator of recession. It's consistent with what the narrative I'm giving you. By the way, the yield curve inverted. The yield curve inverted briefly for a few months in 2019. It's not a perfect predictor of recession. Nothing is, but I think it's an indication that that the bond market sees the economy weakening going forward, perhaps significantly. And this year we're probably going to grow around 2 to 3%, maybe 1.5 to 3%, something like that, Greg. So it doesn't actually take much downward pressure to push us into negative territory, as it turns out. And that's what I'm saying. In 2023, I see that an economy that has been growing rapidly since since May of 2020, has been growing rapidly since May of 2020, could start to reverse course, could lose some ground. It won't be a very deep recession, by the way, but that's my forecast right now for 2023. And if I'm wrong, I'll deny I ever said it, even though I'm being paid.
In perfect Anibal style. Based on the recent events related to COVID, now the Ukraine, do we see the government and or even the private industry positioning themselves to be better protected in the future? What protectionist activity is going on as a result of these unpredictables?
If by protectionist activity, there's two ways to try to think through that question. One is, are we thinking about protectionism in the world of trade, free trade, and so on and so forth? Oddly enough, I think that this Russia-Ukraine situation will actually promote freer trade in the West. It's binding NATO together, right? So we had Brexit, right? The Brexit vote. We had tariffs on, European and other steel from other allies, Australia, so on and so forth. And so some of that unity was breaking apart. And there were some talks about NATO disintegrating, as it turns out. But all of a sudden, with this Russian invasion of Ukraine, all of a sudden, what do we see? Western unity, right? All of a sudden, all these nations saying, we're going to spend 2 to 3% of GDP on our defense, per our NATO agreement. Even the Germans are talking about increasing defense spending. And Germans view, in the course of history, I view that as very bad news. But right now, the current situation, not so much. So I think you'll see actually closer trade relations in the West, even as they try to lock Russia out of trading relations and sanction Russia to death. You'll see that less protectionist activity within the Western world, which I, as an economist, talked about the benefits of free trade. I think I view that as very positive. If one is talking about protectionism from the perspective of protecting society, whether it's cybersecurity attacks and so on and so forth, well, one of the big winners here, as it turns out, Greg, is the U.S. defense establishment. So one of the things you're seeing is orders coming from not just the U.S. military, but also from militaries around the world to Lockheed, Northrop Grumman, Raytheon, and many others. And so one of the things I would expect to see is a lot of industrial construction generated by these defense contractors who are going to see massive increases in orders and will need more manufacturing capacity to deliver to that demand.
Do you foresee oil producers increasing their capital spend on their existing facilities in order to increase production as a result of what you just said? What about the oil producers? What's the expectation there, if any?
Look, my expectation is this. I've been taught this, Greg, that when price rises, quantity supply goes up. Period. That's what right? Price goes up, quantity supply goes up. It's Econ 101. It's like the first lecture you hear. Price goes up, quantity supply goes up. So that's why I've been so frustrated, because I've seen price go up. I have not seen quantity supply go up. What is going on here? And again, I think part of this relates to shareholder dynamics and cash flow models and so on and so forth. But ultimately, I think you will see, not out of a sense of patriotism necessarily, but just from sheer economics and be able to grow the bottom line, that oil producers in America will start raising output. I think you also see OPEC nations start to raise output because these higher prices are so seductive. Right? How can you turn away production at $99 or $100, $100 a barrel, right, of price, when I can make money at $40 a barrel? So why wouldn't I produce that extra barrel of oil? I'm making a huge margin there. It hasn't been happening for much of this last year, but I expect that to happen going forward. Again, I understand the environmental implications of fossil fuels. I get that. But we're going to need a certain amount of oil given the technology that we have in place right now. And again, I'd rather us produce it for ourselves and the rest of the world rather than have the rest of the world produce it for us.
Will the Chinese benefit from these sanctions on Russia? And how do you see that Chinese-Russian relationship changing as a result of this? And what economic impact does it have?
Yeah, that's a wild card, isn't it? So, by the way, that's why the Indians have not been more anti-Russian. First of all, the Indians depend, as I say, a lot on the Russians for fertilizer, food, and munitions. But the great nightmare of the Indians is that that the Russians and Chinese would form an axis, and so the Indians would be surrounded by Pakistan, its arch enemy, which is a nuclear power, Russia and China, also nuclear powers, right? So that's one of the reasons that the Indians, much to many people's frustrations, including many Indian Americans like myself, have not been more vocal about opposing the war. But in any case, the question is about China here, and it's a real wild card. Historically, China and Russia are enemies. And different models of communism, even during the heyday of communism, so on and so on. So I don't see the Chinese trying to do much to strengthen Russia. I think the Chinese benefit from a weak Russia, as does America, by the way, from a security perspective. And the Chinese are not going to go out of their way to strengthen the Russians. It could turn out to be naive because the economics are different, right? The economics are such that I'm Russia, I'm desperate, I need outlets for my my goods. I want to sell my defense equipment to somebody, and so maybe there's a trade relationship there that's quite mutually beneficial there potentially between China and Russia. I understand that, but China actually benefits from having a weaker Russia from a geopolitical perspective, and so I don't think they'll go out of their way to try to help the Russians out.
Interesting. Talk to us about rising house prices, the red hot housing market. Where do you see that going in the future, given the rise in interest rates?
Yeah, my view is that the housing market's going to slow significantly after the spring selling season. So we have the seasonal bump in activity right now. Many people are showing their houses. The house looks great. The sun is out and all this kind of stuff. And so we'll get that. And then also one of the things that happens when interest rates rise is that some of the fence sitters, prospective buyers who are saying, let me wait, I'm not sure. All of a sudden they start to see interest rates rise, say, oh, I better move now because interest rates, if they keep rising, they'll really be locked out of the housing market maybe forever. So I got to move now. So you've got the spring selling season plus that dynamic should translate into fairly steady housing activity through the spring. But beyond that, once you get through that rush, these higher mortgage rates, I think, are really already squashing some of the housing market momentum. I think you will start to see sales prices fall in much of the country. It's not because we have a supply bubble, by the way. We don't have enough housing. But just, when mortgage rates move, they're so significant in terms of their impact on monthly mortgage payments that they really impact housing affordability. And so that's my expectation, is that the housing market's not going to be a catastrophe because there's still not enough supply out there. But price momentum will not be there by the end of the summer.
Talk to us for a moment about offshore modularization. Any chance of some of that activity moving back onshore into the continental US?
Oh, absolutely. I think this is part of the broader reshoring story and has been since at least 2010. The Great Recession, 2007, 2008, 2009, really changed a lot of things. I mean, there were supply chain issues back then, and that induced more American CEOs to want to put more of their supply chain back in America. You might remember that at one point in 2008, oil prices surged to $147 a barrel before they collapsed. And so there was a lot of concern about supply chain and transportation costs back then. Then, of course, with Chinese policies regarding having to be in joint ventures with Chinese companies for business there, with intellectual property issues, so on and so forth, with some of the goading from the Trump administration, more and more CEOs have been thinking about bringing more of the supply chain here. And then, of course, you've got these global supply chain disruptions during the pandemic, sky-high delivery costs and transportation costs, a ship blocking the Suez Canal for a week, all this stuff. And so now even more American manufacturers saying, you know what, it's not China for me anymore. My supply chain needs to be in North America. One of the things that happened in late 2019, Greg, is that Congress ratified the USMCA, the U.S.-Mexico-Canada Trade Agreement. Almost no one talks about it.
It will look a little different.
Hold on just a
We've
second.
changed significant
There we go.
changes.
Craig, can we mute that voice? Thanks. Sorry for the interruption.
No. So that deal, as it compares to NAFTA, the North American Free Trade Agreement, creates greater inducement for CEOs to put more of their supply chain in North America if they want to benefit from favorable tariff treatment. So you put all this together, and I think more modular units will be manufactured in America. I think, by the way, modular units will become more ubiquitous in general. That's going to be an area of market share gain for all kinds of reasons, including labor market reasons we can get into. And so, yes, that'll be part of that reshoring story, and I think it's very positive for America.
The impact of remote work on commercial office space and market. Obviously, there's been an earthquake in terms of the working environments. Working from home has increased. These kind of meetings here have now displaced face-to-face in many instances. Talk to us about the cultural and the economic impact of remote work or work from home options that are being introduced all over the economy.
Yeah, so a few weeks ago, a company called Good Hire, which is a background check company out of California, Redwood City, I believe, California, conducted a survey of 3,500 Americans and determined that 68% of Americans would prefer to work remotely. 68%. They don't want to commute. They don't want to be with their colleagues. They don't like their colleagues. A separate survey found that more than 50% of Americans find their colleagues to be annoying. And so, every once in a while I get into a discussion or a screaming match with a commercial real estate broker. The commercial real estate broker telling me, you know what, this remote work thing, it's not a big deal. Well, I get it. You're trying to lease space. I think it's a big deal. And if you look at the U.S. office vacancy rate statistics, that vacancy rate continues to rise, and it'll rise further as more and more leases come up for renewal and more people downsize. So, I have 2,500 square feet in downtown Baltimore. I'm right now negotiating my next lease on 500 square feet. I have not one worker in the office. They're all remote, and they want to be remote. They don't want to come into the office. They don't like me. So, I think
we like you, Anirban. You're welcome in my office anytime.
Okay, great. I'll see you then because I need the company. But I think that this is going to be, I've said it many times now, but I think the U.S. office market will be one of the weakest segments of the economy. And what that translates into is less construction of new office buildings. Now, you can point me to a place like St. Petersburg, Florida, where, there's still demand for office space because that economy is just so red hot. But for much of America, there's just plentiful office space that's available for lease. And I would expect that in many cases, lease rates are going to decline, or asking rents are going to decline as building owners compete for a scarce number of tenants.
Thank you. What is the impact of the Russian influence on OPEC and decision-making on production targets? Talk about the OPEC organization now and how this affects them and then us.
Yeah, so Russia strengthens OPEC. So there's OPEC, those oil-producing, exporting countries, and there's OPEC plus. So the number of nations like Russia that are not OPEC members, but they work with OPEC, they negotiate with OPEC, and what they've been doing is they've been using their market power to constrain supply and keep prices artificially high. The Americans, meanwhile, have been, interfering with pipeline capacity augmentation, and so that has also kept prices artificially high. So this actually predated the Russian invasion of Ukraine. But a lot, and then of course you've got inefficient operations with respect to oil production in Libya, Nigeria, Venezuela, elsewhere, and that inefficiency causes oil prices to be higher than they otherwise would be. So, in any case, so Russia strengthens OPEC's negotiating position because Russian production plus OPEC's production translates into more market share and therefore more market power. Now, it remains to be seen how OPEC and Russia will negotiate going forward, how they'll interact going forward. But here's the thing. If the West is saying we're not going to import Russian oil, then the Russians lose a lot of that market power that they all.
Anirban, let me interrupt you real quick. You muted your microphone, actually.
I didn't. It's happening to me. I'm not. My hands are like up here. But but again, so with the Russians unable to sell oil into the West, for instance, and we'll see who buys Russian oil. It seems to me that Russian market power and position has been weakened, and OPEC will look at Russia and say, "We don't need you. I mean, you're a liability to us." And you don't offer us much market power anymore anyway, because you can't sell to so much of the world. And so again, that's another reason to think that the Russians are going to be left out in the cold, including by OPEC. I hope I'm right about this. This might be just wishful thinking, but that's my guess.
With 30% of the global wheat supply originating in Ukraine, how will these North America producers and commodity pricing be impacted by these anticipated shortages that you mentioned? Talk to us about food shortages as it relates to the Ukraine supply chain, if you will.
Yeah, look, I mean, we've got a shattered society. I mean, look at these, these built environments. I mean, I know we've got a lot of folks in construction, and you love the evolution of built environments, right? New buildings, new structures, new technology, so on and so forth. And to see all of this destruction, including of historic structures, is very painful to watch. Right? A democratic nation with all that history, it's just very painful to watch. The destruction, the undoing of the built environment. But it's going to take years to rebuild that Ukrainian economy, though it may not take years to rebuild wheat production, just because of the nature of wheat production, right? The land is still there. And so there's labor force issues, so on and so forth. The land is still there. So in the short term, we are the world's breadbasket. As important as Ukraine is in global wheat production, we're more important. And so in my mind, what happens? Wheat prices have gone up. And so what does that say to the farmer in Nebraska, Iowa, Illinois? It says Kansas. It says to them, hey, allocate more of your land to wheat production this year. And that's what's going to happen. So I don't know that you're going to have any food shortages that come from an inadequacy of food supply. Food is going to be more expensive, but it's going to be available, and the world has the ability to feed itself. Even the Indians, who were starving in the 1940s, are now a net exporter of food, a source of enormous pride to the Indians. So I think there's enough food and enough global capacity out there to make up for the Ukrainian loss.
Another question: what is your greatest surprise in terms of this Ukrainian-Russian conflict? What was the greatest surprise or cocked eyebrow moment when it came to the economy?
With respect to the economy, I mean, the greatest surprise, of course, is the inadequacy of the Russian military, right? That they have just been foiled. And so I guess my greatest surprise is that oil prices are not even higher.
Really?
The conventional wisdom was that if the Russians invaded, that oil prices, which were, if you remember before the conflict in the 80s, if memory serves, something like that, and then there was $120 a barrel. And then the war is sort of bogged down. It's just an ongoing thing. And meanwhile, the sanctions keep coming, right? I mean, the Biden sanctions on purchasing Russian oil and natural gas are actually quite recent vintage. And yet we're looking at oil prices that today are less than $100 a barrel. So I've been actually surprised by that. And again, one of the things that happened is that the Chinese economy got infected with Omicron. And so that has, caused expectation of demand to fall. It could be also that the Federal Reserve's hawkish discussion about its monetary policymaking has people expecting weaker economic growth going forward, and that is also caused. By the way, oil is right now at $99.99 in North America, West Texas Intermediate and May futures, and so that's been my biggest surprise. And in fact, there hasn't even been greater effect than there has been.
Another question, what impact does all of this have on technology? And have you seen any emerging technologies that we should be mindful of?
Well, certainly military technologies, right? So the Ukrainians are making magic with drones, as it turns out. And we're talking about mid-grade level drones produced by the Turkish military, or the Turkish defense establishment. So I think it's military technology, defense technology, that I think has really gotten the push forward here. And of course, the Americans are the greatest producers of defense technologies in the world. So you can imagine what it means for our defense establishment. The Biden administration, by the way, is pushing up expenditures on defense. So we saw a big increase in defense expenditures during the Trump administration, and it's ongoing during the Biden administration, which I don't think a lot of people predicted. So I think that's where I see technology, really playing a part. Defense technologies. We'll see what we learn from laser technology and drone technology and what kind of civilian applications there can be. But that's been the technological push here.
Here's another question. It's quite interesting. So inflation is up, but why are the cost of construction projects even higher than the stated inflation rate? And will this not be limiting the number of projects in the private sector?
Yes, I mean, that's right. So
tapped on that before.
Yeah, well, I mean, as I say, consumer inflation as measured by the Consumer Price Index is up 7.9%, but materials prices are up 24.4%, and steel prices, or steel mill product prices, last I checked, were up about 75% over the past year. So, so
can you give us those stats again? Did you say inflation 7.9 and
materials prices 24.4?
Materials 24.4, so almost up a quarter, and steel prices 75% over a year ago.
Yeah, I want to look this up right now. I want to make sure I'm correct, but it's a huge number. I have a presentation up. You can't see it, but that speaks to this. So I want to look. I'm going to give you some quoted prices right now.
Sure, please.
In terms of year-over-year percentage change, just so. So steel mill product prices up 74.4% between February of 2021 and February of 2022. So that's an enormous construction input.
Jump, yeah.
Concrete, which is ubiquitous, right? One of the most widely utilized materials in the world, is up 10%. Iron and steel prices, that category is up 50%. 50% 1 year. Natural gas is up 48%. So while the consumer is facing 8% inflation, contractors are facing much higher inflation than that. And of course, on top of all of that are these wage pressures because of a lack of workers. And particularly skilled workers, by the way. So that's why you see so much inflation in construction relative to the balance of the economy. And then the question becomes, do projects move forward? Well, as I've said, backlog is pretty stable. Indeed, I conducted a poll recently on a separate presentation, and a significant fraction of those contractors in that presentation said we expect our backlog to grow over the next year,
even in spite of these
despite this
outrageous increases.
Which means a lot of project owners are saying, I got to move forward, whether it's a data center, a fulfillment center, a hospital expansion, an industrial facility. I mean, so we can talk about the weakness in the office market, hotels, retail, particularly shopping malls, those categories. But you're seeing a lot of construction in these other categories, more industrial categories, warehousing categories, so on and so forth. So the average contractor is still pretty busy and expects to get even busier over the next year. Now, my question is, are they right about that expectation? Or will, in fact, these very high delivery costs cause many project owners to pull back on construction, to delay projects because of the logic I've put forth, which is you might get more favorable bids at some point in the future.
So, and I know we only have a few minutes left, but from the construction owner's viewpoint, when they go for contractor pre-qualification, what is the one thing that the contractor, or one or two things the contractor is most concerned about, and what should the owner be getting information on regarding that contractor? So talk to us about the contractor pre-qualification, all these price increases that you mentioned. When owners go to pre-qualify the contractor, are there any new things that we should be poking around about? And secondly, what are contractors most concerned about moving forward in the next year, 18 months?
Well, from the perspective of a project owner, what's the issue here? That you have to have the project finished, that the contractor has to deliver. And right now, since contractors are so busy, you might not be able to work with your first choice contractor, right? They might be spoken for their capacity. And so the question becomes, in this inflationary environment, with materials prices so volatile and workers moving so quickly from job to job to job, so much tumult within the labor force, does a contractor have the wherewithal to deliver on time and on budget, or at least close to on time and on budget, right? In the construction, we don't necessarily assume on time and on budget, right? But close to that. And that's if and I don't want to settle for a contractor who's not A grade, right? Because the people who use that office building or whatever's being constructed, that convention center expansion, deserve to be in a structure that is A grade in terms of construction, including safety. So that's, now what are construction firms worried about? Here's what I think they should be worried about. Mass cancellations or postponements of projects currently on the books. So is it possible that projects are right now as part of backlog, they're ready to or scheduled to move forward, and then the project owner says, you know what, this has broken my pro forma, I can't move forward. Or my interest rates have gone up, and so all of a sudden my pro forma is broken because my cost of capital is up. And then ultimately, of course, what happens if there's expectation of a recession in 2023? Do I still want to move forward with this project if the economy is going to weaken just as I come online? So that's what I'd be worried about if I'm a contractor: project cancellations and postponements. And as I say, we've had a surprisingly small number of them thus far, based on backlog, for instance. Contractors still busy, but could that change going forward? I think it could.
Final question. What are the key takeaways from this presentation that we need to know about the economy, and what do we need to be tracking and watching very closely as we move forward for contractors and owners?
Greg, this is what I've learned. That sometimes you turn the spigot and the water does not come out. That for a long time, we took the supply chain for granted. If there was demand for a product, the supply would be there, it'd be there. But now what we see is an incoherent global supply chain, and we don't seem to be able to get out of it, right? Whether it's Omicron or war, whatever it happens to be, or worker shortages, we continue to have these equipment shortages, material shortages, so on and so forth, and of course, very high delivery costs when in fact those goods are in supply. So that's what I've learned from the war, from this whole pandemic period, is that you can't take the supply chain for granted. You can't assume that when you flip the switch, the lights are going to come on. That a lot of hard work has to go into making sure that the water runs, electricity runs, so on and so forth, that goods get delivered. And anyway, those supply chain challenges could persist for a long time to come.
Great. I want to thank you, Anirban. You have always been substantive in your presentation. This is not an exception. We thank you in short notice for joining us. We also want to thank our participants. We had nearly 200 at peak on this call today. For those of you who are still with us, I will remind you that we did record the presentation. Anirban's slide deck will be made available to you early next week. So we need to give the staff here a little bit of time to make sure we clean things up appropriately, and then we'll get that out to you, and you're welcome to distribute that. I'll also remind you to take a look at curtevents.com. That's C-U-R-T events.com. You'll find all of our virtual and face-to-face meeting dates there, most particularly the May events that are coming up, the Curt Connect April 20, the webinar on opioids and safety on April the 13th. And as always, we thank you for joining us. Anirban, once again, thank you. You folks have a great weekend. Take care of yourself and each other. Thanks for joining us.